In my most recent video, I shared with you guys how I just sold a rental property and that's gonna free up about $150,000. So today, I wanna walk you guys through my thought process of how to invest $150,000 lump sum right now. Time to think like an investor. Hello and welcome back to the channel. If you're new here, my name is Josh. I'm a 6th-year certified financial planner and I run my own wealth management practice. Now, this channel is all about young investors, financial advisors, and how to optimally make the right financial decisions with your investments or your taxes or these sorts of things. So if you're into that, make sure to hit that subscribe button below and hit like on this video to help us get more content out to you guys absolutely for free. But let's get to the point. Today, we're gonna be talking through how to invest a lump sum of $150,000. And depending on where you are, this can be either a very tricky time or a very opportunistic, advantageous time. If you're young, you're starting to see some crazy things happen in the market for the first time maybe. We're seeing markets decline and decline and decline for a long period of time. The stock market's almost in bear territory. It's down about 16%. The crypto market is down almost 70% over the last year, and safe assets like fixed income, things like bonds, are actually getting crushed as well. So for a retiree, if you're someone who's hoping to start withdrawing investments so you can retire, yeah, pretty tough time. I don't envy you. But if you're a young person who's got a lump sum of money to invest, kind of like me, this is actually a fantastic time to think about how to strategically allocate that money. More importantly though, I want to take you guys through my process of maybe how I would actually do this with a shoe on the other foot. If a client was in my position, what would I tell them to do? How would I advise them in this situation? And you'll see how my process might differ a little bit from where you might start thinking. And for most people, the first thought is, where should I invest this money for the optimal return? And so we have a few different options at our disposal, and there's a lot of uncertainty, right? We have things like stocks, which are kind of crashing, and who knows, maybe you already have a pretty healthy allocation to stocks. And then there's crypto, and that's declining quite a bit. And we hear about things like inflation running really hot, which hurts a lot of assets. It hurts safe assets like bonds, it hurts cash, it hurts stocks. You have things like interest rates starting to creep up. And if you're into investing, you realize that hurts stocks as well, and that certainly hurts bonds. But what you guys might find in today's discussion of me opening up my finances and goals and what I want to do with the money, you'll see that someone like me who is young and aggressive and maybe has enough money invested in traditional asset classes like stocks, bonds, real estate investment trusts, these traditional things, maybe with the money left over, there's room to start looking for areas of differentiated return or maybe alternative investments. For those of you who don't know, those could be things like private equity, investing in private companies, venture capital, and reinvesting back into my own business, or using a platform to get involved in collectibles, maybe like artwork, for example. Now, historically, this would have been nearly impossible, but thanks to the sponsor of today's video, Masterworks, you can actually own high-value investment pieces of blue-chip art like Picasso, Banksy, Monet, Warhol, that were only available to the uber wealthy but are now available to retail investors like us. Now, although future returns in any investment are pretty unpredictable and you can't use the past to rely on future returns, we know that high value art has been known to outperform historically during periods of high inflation, like the one we're in today. Unfortunately, Masterworks does have a wait list, but if you use the code in the description below, you can skip the line. Either way, be sure to check out Masterworks to learn more about the new frontier of fractional ownership of alternative assets like art. But as promised, I want to give you guys a more detailed and philosophical breakdown of where exactly this money is going to go. So $150,000 that I'm going to clear from this property unfortunately gets diminished down to something more like $125,000. After we pay for renovation costs, realtors, lawyers, all these sorts of things, about $25,000 gets taken away in these other costs that unfortunately just leave the door in a transaction like this. Now, I mentioned my process might seem a little different than a lot of people's, okay? Because I think the default that most retail investors or people would look at if they found themselves in a situation like myself, they come into $125,000 to invest free and clear, they think, okay, what is going to go up the most? Investing. But this is where I disagree with that philosophy. I think the most prudent way to manage a situation like this is to look at it holistically. Not just think about how can we double this money again. The thought is more so, what does my life look like? Where do I want it to go? Where am I weak? Where am I strong with my finances? And how can I take this opportunity I have to work on my weaknesses or propel the strengths that I already have? And so the way we look at this holistically is, instead of just thinking about investments, I want us to think about 4 different areas. The 4 key financial planning areas. The first one is cash flow. Every single thing in your life that is good or bad about your money is downstream from your cash flow situation. If you're spending more than you make every month, you will always decline into zero or even into negative, into debt. If you are earning more than you spend and you save the difference, you will always end up with an increasing ledger. You'll always end up in a positive direction. So cash flow is first. How does my cash flow picture look? Does that need to be improved, and can I use this to help me? Second, financial independence or retirement. We all want to work towards a situation where we have enough wealth or assets that it produces an income for us. We're not forced to go to work. We can choose to go to work, or we can choose to work whatever project we want to work on because we're not forced to go trade our time for money. How can we build enough wealth that the interest provides money for us to live? Okay, that's part two, financial independence. Third, risk. Have I taken into account all the potential risks I face in life? What if I were to die? What if I were to get disabled? What if I were to get cancer? What if I were to have a massive financial emergency? What if something happens to me or one of my possessions that is a massive financial hit? Am I safe from all the things that life could throw at me and derail my investment plans? That's third, risk. And lastly, taxes. How can I look at the situation that I'm in and make sure I'm eliminating as much of the tax ramifications as possible so we have the government eating into this opportunity as little as legally possible? Those are the four areas that we're going to look at this through instead of just thinking, how much money could I make by throwing this into Ethereum? Let's quickly talk about cash flow first. For me, this is the biggest strength I have in my entire financial picture. It has been my goal since day one of my financial journey to increase income and decrease expenses and hopefully make that income more recurring. For me, cash flow, having more coming in than going out and increasing the amount that's coming in on a recurring basis has always been priority one. Over and above selling something big or making big lump sums like flipping a house or whatever. It's always to me been about recurring income because everything, like I said, is downstream from that. So I'm not exactly sure that this $150,000 needs to help improve my cash flow. Maybe for you, if you are someone who's like, every single month there's always a little bit more going out than coming in, what I might say is, well, you need to automate your investments. And if you feel uncomfortable contributing every single month to force yourself to save, maybe use a lump sum like this to provide a massive float in your checking account. Maybe throw $10,000 in your checking account that just sits there so that you can get in the habit of constantly contributing money every month. For me, I'm very lucky. I'm currently saving about $5,000 every single month. Now, only $1,250 of that is automated. The other amount I have to either do manually or ends up getting spent. However, I have no excuse for just setting up a corporate investment account and throwing it all into an S&P 500 index fund until I find something else to do. So on a cash flow front, all I'm really going to do is maybe take $5,000 and increase the float of my checking account to make it easier to have larger automated withdrawals. And then I'm going to set up an automated withdrawal within the corporation to a corporate investment account so that every month I'm not just automating $1,250 of savings, but I'm automating the full $5,000. I think that's something that, given this influx of cash, is going to be much easier to do now than it would have been to do 3 months ago. Now, let's talk about number two in the holistic planning idea, which is financial independence or retiring, right? Now, for a business owner, I get this all the time. It's kind of tricky because I want to invest in all sorts of ventures. My business is going to grow. I don't know what retirement might look like. I don't know what my future is going to look like. There's so much uncertainty, but hopefully it's going to be a lot better than now. Why would I want to prepare for retirement or invest in boring things like a 401k or an IRA or an RSP? Why should I care about that stuff, right? And so I take the position that yes, that makes sense, but you want to make sure that your baseline, the minimum of what you are willing to accept, is taken care of with traditional methods, traditional investments, traditional tax strategy. And that way, you know that if your business doesn't go where you want, or for whatever reason, your ambitions don't turn out the way you thought they would, you still have that baseline prepared for. As a business owner in that same position, thinking those same thoughts, the idea is this: I want to make sure, for me personally, that I have $100,000, which in my profits is about $69,000 after tax to spend, after inflation, after taxes, $69,000 to spend from age 55 till 95. That's kind of like my minimum baseline retirement. It's a little ambitious to say I want to retire early and with about 100,000 gross as my baseline, but that's it. That's what I want to prepare for. And so for me, luckily, I'm a financial advisor. I have all the tools at my disposal to figure out, okay, what are my government benefits going to be? What's my pension going to be? And how much ultimately do I need to have invested to create that level of income going forward. And as you can see here, this is my software projecting out that what I really need to make that happen is about $2.2 million. Okay, so I need $2.2 million saved 29 years from now. Now, I can easily reverse engineer that for us right here on my phone. Okay, so how much do I need to save so that I have $2.2 million at 55? Well, I have 29 years to get there. Let's say I'm going to invest all in stocks because I'm a very aggressive investor. I'm very young. I have a long time horizon. Historically, stocks have gotten about 11% per year. I'd like to be a little more conservative and assume maybe 8. Okay, the future value, like I said, we're trying to get to $2.2 million in the future in 29 years. Now, like I mentioned before, I am saving. I have positive cash flow of about $5,000 a month, but only $1,250 of that is automated to retirement accounts, okay? So I can't use or rely on all $5,000. I'm gonna rely on $1,250 a month, which is $15,000 per year. So we're putting away $15,000 a year. When I hit this PV button in the top right corner, that's gonna show me how much of a lump sum I need to have right now, given my savings rate and what I want in the future. And what it shows is I need to have $68,750 stuffed away in retirement accounts with my level of savings to get there. Now, I have this new lump sum of $125,000, but the great news is I already have that invested. So I don't really need to use any of this $125,000 to meet my baseline retirement, which means with this $125,000 that's left over, I can use that purely for taking intelligent risks or bolstering other areas of my holistic plan that need attention. Because for me, the baseline is taken care of. There's no more attention that's needed there. That's gonna chug along and do its thing, and retirement is going to happen. Now the goal is, how do we make it better? How do we, really catapult ourselves to a next level? Now, although I don't have to put money away to retirement accounts, I'm gonna be talking a little bit later about why I should be. And I'm going to have to put away $30,000 into an RSP, but we'll talk more about that later. Now, let's talk about part 3 in the holistic financial planning picture, which to me is risk, okay? How are we prepared for the things that life's gonna throw at us? And for me, that comes down to 2 major things. Do I have an adequate emergency fund? Some people say 3 to 6 months in expenses stuffed away for emergencies. And am I adequately insured on my assets and my earnings? What are my biggest assets? If they blow up, or if all of a sudden I get in an accident of some sort, are those things covered? Now, let's start with the emergency fund piece. For me, I think it's a good idea to probably have a little more float. I'm the kind of guy who tries to keep my checking balance to the smallest amount it possibly can be so I can have the most money working for me. I should have more. And so I'm probably not gonna be the kind of guy who wants to have $10,000 in an emergency fund, because fortunately for me, all the emergencies that have really happened over the past couple of years have easily been managed just from cash flow. It's not great because it might eat into monthly savings, but at least I'm not keeping so much money in cash that's not working, right? So for me, out of this $125,000, the first thing I'm really gonna do with it is probably take 5 of it and just drop in a cash savings account next to my checking account to have a bit more of a float for the day-to-day stuff and any of those emergencies or opportunities that come up. In terms of insurance, I actually already have life insurance. That's nice. I mean, I don't even have dependents, but the reality is life insurance is very cheap to buy as a young person, especially if you want something that will last your whole life. Most forms of life insurance go up in premium. Your costs go up exponentially every 5 or 10 or 20 years. And so for me, I wanted to buy something young that was relatively more expensive, but I will have for my entire life. So I have a permanent insurance policy that will guaranteed payout when I die someday. It doesn't matter if it's tomorrow or when I'm 110. There will be value there that will be paid out tax-free. So on the life insurance front, I'm taken care of, especially because I have no dependents. In addition to that, I also have adequate car insurance and insurance on my possessions and renter's insurance and all this kind of thing. But one thing I've been putting off far too long, which I don't have, is critical illness and disability insurance. If something happens to me where I get cancer or I end up on the wrong side of a city bus and I can't work anymore, what that means is that my income might go away, or I might have to dig into investments while I recover. And this happens all the time. This is a key reason why a holistic plan will have a little bit of defense baked into it too. If I'm putting away $5,000 a month, why not have $4,800 of that go towards offense and maybe $200 go towards defense? Why not put some money towards something that's going to protect all my investments in the event that I get hurt? A lot of people in their 40s get a horrible diagnosis, they have a massive accident, and all these plans they had for retirement or travel get completely derailed. And all they have to go to is their investments to withdraw to zero or GoFundMe. Luckily, I'm a licensed insurance broker, so I just looked up what would it cost for someone of my age, my health, my occupation class to get critical illness insurance and disability insurance, so those things are taken care of and they don't have to be back in my mind like that's some lazy thing I'm putting off. And it's only $75, $76 a month. So what I'm going to be doing now that there's this lump sum and I'm reevaluating my finances is probably saying, hey, it's time to buckle down and protect this money you've built up with some insurance. Now we're on to part number 4 of the holistic financial picture, which is taxation. How can we reduce the friction or, the little pocket picking that the government is doing with all these different assets? Legally and within the realm of their rules, how can we minimize the drag, the taxes? And so for me, this year is going to be a big one because this property I sold for $80,000 more than I bought it for. And what does that mean? That means there is capital gains tax. Half of that gain, or $40,000, is going to get added to my tax bill next year. And so I have to figure out how to minimize that. Luckily, there's lots of deductions. I lived in the property for a long period of time, which means not the whole thing is taxable as a rental. I put a lot of improvements and repairs into the property. They were realtor fees and lawyer fees and all these different things I can deduct against that sale. And so what this ultimately means, I mentioned before, although I don't have to put more money into retirement investments, I am going to need to take about $30,000 of the remaining $120, and I'm going to have to put it into an RSP, which is the equivalent of like a 401k or an IRA deduction in the United States. It just makes sure that all that income that's going to get added to my tax return also gets deducted against to wash it out, so I don't have to end up paying any tax on the sale of the property. But the great thing is there's still $90,000 left over, and it feels like the holistic picture is kind of taken care of. So with that $90,000, we can really dive deeper into the investment picture itself. What are the strategic moves I can make now that I've done the smart adult thing of ensuring the future is looked after in each of these respective areas? Where can I now take really intelligent risks to catapult this money forward? So let's dive into the investment piece. For me, being young, having high risk tolerance, and having a lot of cash set aside for strategic risks, it is a great time to be in this position because, as you know, the crypto markets are down like 70%. The stock market is almost in correction, Tory -16. Bond markets are doing very poorly. Interest rates are going up. Inflation is scaring people. And as wise investors know, that is the perfect time to invest a lump sum of money. Now, hopefully this declines even further, but most people would look at the situation and think, oh my goodness, this is the worst possible time to invest. Like, with crypto investors, it's all the rage when the price is going up and up and up, and nobody talks about it when it's falling. But that's the time you need to be a buyer. So for me, I'm very fortunate, I'm very lucky, and I'm hoping this slide in asset prices continues, selfishly for myself, because it would be a great time for me to invest. Now, with this remaining $90,000, how might I break that up? How might I invest that into the different asset classes? What am I thinking? Well, as I mentioned, the traditional stuff is taken care of, so I can get a little more experimental. And so I've got my eye on 3 main ideas. The first would be leveraged stock market investing, borrowing money from an outside institution to invest at a market low. That's idea 1. Next idea would be cryptocurrency. I love the idea of what the blockchain can do. I'm not exactly sure which coin prevails. I'm not exactly sure how long this rut lasts, but I don't think it's going anywhere. And with the political instability, I think it's a really good idea to have at least a small percentage of your portfolio in crypto assets. And then lastly, things like collectibles, art, jewelry, those sorts of things that are fun outside assets that I can maybe physically own and make money off of by doing so. And so depending on how the markets move here, I like the idea of putting $65,000 of the $90,000 in reserve to buy really great high quality companies on margin, which means taking out debt to invest if the market continues to drop further. It's not something I would be very excited about doing at the top of a market peak, but if we see a major correction that's statistically unlikely to go further, like -35% or -40%, what I could do is I could deposit $65,000 into a margin account, and my broker will allow me to borrow 3.3 times that. So if I put in $65,000, I will have $216,000 of buying power. If I buy really great high quality companies at the low and watch those recover over the next 3, 4, 5 years, we might have serious gains on our hands. And that's where I'm most comfortable in the stock market, investing in great durable companies. And with the remaining $25,000, that's what I would allocate to crypto and collectibles. Maybe $5,000 or $6,000 to some collectible assets, $20,000 or so into probably Bitcoin and Ethereum, maybe Solana, that we can watch recover in value when the next crypto craze comes around. And so there you have it, guys. Here is the final breakdown of what I would do with the net $125,000 I'll be getting from the real estate sale. It's probably gonna look like $5,000 into a savings account just to have a little more float lying around. From there, it's going to be $30,000 into an RSP to eliminate the capital gains tax on the property. From there, I'm going to have quite a bit of money left over, which I'll get involved in some of these other asset classes we just talked about, some strategic growth style risk investing. And then lastly, we'll be doing some stuff with insurance, applying for critical illness and disability, and also increasing the automation of my investments, both personal and corporate, to add up to something more like 5,000. So anyways, guys, this has been a very long video, and I'm thankful to you for sticking around. I hope that you got some value out of it. Looking through the eyes of a CFP, looking at their own finances, seeing how I would manage my own stuff, taking a more holistic view rather than thinking, oh my goodness, I have 125,000. Should I put it in Tesla or Bitcoin, right? It's a little more intelligent, mature way to think about things. So if you got any value out of this video whatsoever, make sure to hit that like button below, hit subscribe, and turn on post notifications for more videos just like this one every single week. Until next time.